Hi, and welcome to the Morton Brown Family Wealth Weekly Market Update for the week of October 12th, 2020. I'm Dennis Morton here with Katie Brown and Cody Demmel. How are you guys?
Great. How are you?
Good. So we're here at the beginning of earnings season. We're starting to learn how some companies fared during the third quarter of this year. So what should have been a real bounce back from the depths of the pandemic in the second quarter. So we'll talk a little bit about Apple, JP Morgan, and some results that came out this week. We're also going to talk about the endowment investment model, specifically the Harvard endowment, lessons we can learn from how major institutions invest. And then finally, we're going to talk about donor-advised funds, a charitable strategy that's actually doing pretty well, both for the charitable beneficiaries and for donors this year. So let's start with earnings. And we've seen a couple of companies reporting this week that were highly anticipated. I don't think any more so than Apple. Anytime Apple comes out and makes a big product announcement and starts talking about what they see coming down the line, it generates a lot of excitement. And this week it was a product launch. So we have 4 new iPhones coming out. Apple is leaning into the 5G experience. And I think there was a lot of investor anticipation to say, well, is there something new? Is there something big? And I think it's interesting to point out how Apple thinks about these product launches and how investors and consumers think about the product launches. I mean, guys, we've all kind of in our adult lives have migrated from iPods and MacBooks up through just this whole ecosystem that's built up, right? And we don't expect Apple to nail every one of these launches. I think the history says that, the stock usually drops the day after a lot of these launches. I don't know what the data is, but it dropped yesterday for sure. Yeah. But really what we focus on is Apple in the second quarter of this year produced $14 billion of free cash flow. They're not as concerned about a big hit every time something comes out. They're saying, what are we going to use this cash to create in the long term? Now, you guys are both in the Apple ecosystem doing things. Cody, you got your AirPods in. But I think the whole idea is, as an investor, we look to them to be good stewards of that huge trove of cash, whether it's paying dividends, investing in the long-term future, and building out the ecosystem. So we're less concerned with the short-termism of the product launch and more interested in how are they taking that cash and deploying it the right way over time. They've just built up that trust, and it's made them a great company. Speaking of other cash reserves, Cody, there's JP Morgan reported earnings this week. Talk about how they're thinking about the amount of cash that they have to keep in reserve right now.
So JP Morgan and Citigroup both reported earnings on Tuesday, and both beat on the top and bottom line, which is obviously great to see. But I think the most important items that they spoke about were the assets that they set aside, or actually JP Morgan reduced the assets that they set aside in the third quarter. Compared to the second quarter, JP Morgan had to set aside $11 billion because they were concerned about all the bad loans that were potentially going to affect their business going forward. I just thought that was great to see as a sign for the economy recovering.
So what does that look like as the recovery? Like, what does that mean for JP Morgan if they don't have to recognize some of these losses?
Yeah, so I mean, obviously that helps their profits moving forward. They don't have to set aside, the $11 billion that they did in the second quarter, so they can use those assets for other business investments, which is hopefully what we'll see going forward. And I think it was important, Jamie Dimon, their CEO, said their base case, they'll actually have an additional $10 billion over reserved in their loan provision losses, which is great. Hopefully the economy keeps improving and that will happen.
Yeah, that's a great sign of optimism right there.
Yeah, I think through all of this, we've just been trying to figure out where the stress points are. Like, is the healthcare system going to be stressed? Is the financial system going to be stressed? And any signs of relief there, I think, are pretty welcome, especially now that we get to see some results. So
yeah. Especially because JP Morgan's the biggest U.S. bank by assets, so that's definitely great to see. And it wasn't Citigroup had a similar in the second quarter. They set aside around $8 billion, and in this third quarter they set aside only $2 billion. So it's great to see.
How about investing styles? There's this idea of investing like an individual retail investor, and then there's this endowment model. Cody, you found an article about the Harvard endowment. Tell us a little bit about that.
So it was an article by MarketWatch that was going over the Harvard endowment's returns. The endowment actually underperformed for 12 straight years compared to their benchmark.
Yeah, that endowment, I remember starting out in my career in the mid 2000s was right at the tail end of a period where the Harvard endowment had beaten the benchmark for a long period of time. And everyone was trying to emulate that. There's this idea, the Harvard endowment and Yale, they were investing in all these illiquid assets like timberland and all of these, and farms and just these really large monolithic assets. And that was giving them a lot of their performance until everyone tried to emulate that and do the same thing. And suddenly those things became very crowded. And it all starts to fall apart when that becomes a crowded trade.
Yep.
I think the other thing that's interesting too is the time period where they were beating the market. So for a 15-year period ending in 2008, they beat the markets by 5% on a year-over-year basis. And then the 12 years after that, they underperformed each year. Well, if we think about what was going on in the markets for those 15 years ending middle of 2008 versus what's happened in the last 12 years, it's been a much more volatile, it was a much more volatile period in their outperformance years. So I think there is something to be said there for certain times when a certain level of management works, and other times where indexes just following the ride may work too, and maybe even in certain parts of the portfolio where that management works better.
I'd be curious. This didn't come up in the article, I don't think, but I would wonder, you think about in that period, late 90s, early 2000s, what might have helped them to outperform is maybe what they didn't own. I don't know how much they were exposed to tech stocks and IPOs and a lot of the tech industry. If they missed the tech bubble bursting, that can lend a lot to outperformance. But on the flip side, if they still didn't invest in tech over the last 10 years, then you missed out on all the outperformance to the upside. So I wonder if that it's not just what you own, but what you don't own there too.
Yeah.
So Katie, on the charitable side, financial planning, we're coming up on year end. That's always a big time where people think about how to accomplish their charitable objectives. You found an article on donor advised funds. Tell us what that was all about.
Yeah, the interesting article, actually, let me just say really quickly what a donor advised fund is for some people that might not be as familiar. So a donor advised fund is a charitable fund. It's super simple. Individuals, families could set it up oftentimes at their custodian. So it might be, Fidelity, Schwab, or at your local community foundation. You can set up a fund there. You can gift into it. So if you gift, say, $10,000 into the donor advised fund, you get the charitable deduction for that gift to the extent that you qualify. But that money is in there, and then you can disperse it out as you wish going forward. You don't have to, once you put that money in there, you don't have to say, all right, this $10,000 is going to this organization. You can spread that out over several years. You can disperse bits and pieces of it to different places. So it's a very flexible way of charitable giving, but a great way to capture the tax benefits of charitable giving on the front end. So back to your point, Dennis, going into year end, you're right, people think about charitable giving. This year, however, has been fascinating because people have been thinking about it all year long. And one of the interesting things in Financial Advisor magazine, they noted that charitable giving was up 44% from February to June of this year versus a year ago. And a lot of it going to, religious organizations or COVID relief funds and other areas that were really impacted by the pandemic. I don't know about you guys, but I've heard a lot of that as well. I know from some of the local nonprofits and some of the local churches how happy and just grateful they have been for their, congregations or their supporters to give as much as they have given this year and to really help to keep them afloat. But the thing about the donor advised fund is that there has been such a boom, such an explosion in the use of these funds over the last couple of years, but even more so this year. And like I said, it's a great vehicle. I just love the idea that you can gift into it and then kind of make your decisions, your more specific, intentional decisions about where you want that to go.
Mm-hmm. And at the end of a year like this, and we hear of people that are, whether they're selling a business or retiring, they might have a unique tax situation. It allows them, you can make a substantial gift in one time, capture the benefit in that given year, and then, turn to your family and engage in conversations and say, how do we want to do this? How do we want to sprinkle this out over time? What causes do we want to support? We found it to be a great way for families to have more in-depth conversations about philanthropy.
Yeah, absolutely. And you're right, to couple that with a windfall whether it is through a transaction of some sort. That's definitely a strategy that can be really advantageous, or even something that we've seen since the tax reform in 2017. And with the higher itemized deductions, you don't always capture that full charitable deduction because it may not be above the standard deduction. And so this is a great vehicle where you could, they call it bundling, where if you normally give $10,000 per year, maybe rather than giving $10,000 in December this year, you give $20,000 in January next year. And then you can do kind of your gifting from there. But that's, 2 years of the gifting in 1 year, and now you can capture the deduction as well. We see those vehicles used that way pretty often.
Great. Excellent. All right, guys, we're coming down on the last 2 weeks of October. So it's really gut check time and figuring out what are you going to be for Halloween this year. Whether trick-or-treating happens or not, I expect the costumes still need to be there. So Cody, why don't you start? What's the Halloween plan for this year?
Yeah, Courtney and I will be going to Ohio to visit her sister, brother-in-law, and their new nephew. So whatever he is going to be, I guess we will be dressing up as something similar.
Bring options. Yeah, be flexible. It's good. It's good. Katie, how about you? Any Halloween costume plans?
I still had to figure out mine. My gut tells me some sort of animal to go with my daughter because I know she's going to be a raccoon. We're currently in the process of making that costume. We're about halfway over the tail. Having a lot of fun there. Good.
Yeah, I think anymore it's process of elimination of what I'm not going to be. So this year, I'm guaranteed to not be the man in the yellow hat from Curious George, which is an oldie but a goodie, and not be Peter Pan carrying around Tinkerbell. So the green tights have been retired, the yellow hat's been retired. I'm a free agent this year. I could pick anything. So I'm going to think hard about this weekend. I'll let you know where it goes.
Nice.
So, all right. Well, hope everyone's doing well. If you have any questions about investing or planning, feel free to reach out to our team at any time. And we wish all of you and your families the best. Take care and have a great week.
Bye. Take care.